Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. Thank you so much for joining. If you have questions or topics you wish to discuss, please chat those over now so that we can be sure to get to them all. I see that we've got some questions already that have been chatted up, which is great. Thank you so much for bringing the questions. We'll take those before we get into the content that we wanted to share. We're excited today to discuss the $72,000 Schwab Roth IRA hack for 2026 via the Mega Backdoor Roth. So this is our second session of the day, a second daily Solo 401k webinar and Q&A session with my Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. Again, this is your chance to get answers. Please use the chat to ask questions on today's topic or anything else. Please chat them over now so that we can be sure to get to them all. All right, let's jump in with the first question. Does this sound like the correct strategy order of operations? I value highly Roth dollars. Small side income LLC, contribute to my day job, about $5,000 to my day job 401k. I'm set up as an LLC, max my Roth IRA, then contribute after tax only in my solo, then in-service distribution to my outside Roth IRA. Also considering contributing 20% of my LLC income to the pre-tax bucket. Am I on the right track of organizing my contributions? Day job and my solo would need to stay below 72,000. So that's a great set of questions there, and it's not uncommon. We have a lot of side hustlers. In other words, someone that has a 401k through a day job and then also has separate side self-employment income. And the beauty of it is that if you are self-employed, so you're reporting earned self-employment income with no non-owner, non-spouse, full-time W-2 employees, and you have a 401k through your day job, you can still set up a solo 401k based on your self-employment activity. And number one, with a plan offered by my solo 401k Financial, our plan allows for tax diversification. In other words, individuals can make pre-tax contributions as well as Roth and or Mega Backdoor Roth contributions. Now, in terms of for someone that's maxed out their contributions to their day job plan, or let's just assume made contributions to a day job 401k, like it looks like in this case, you've made about $5,000 in contributions to your day job 401k. That employee contribution limit, which is 24,500 for 2026, that applies across all the plans that the employee participates in. So if someone contributes 24,500 to their day job 401k plan, they're not going to be able to make any more employee contributions to the solo 401k. However, the employer contribution limit, the voluntary after-tax contribution limit is not reduced by contributions made to a day job 401k plan. So if you have the earned self-employment income to justify the contributions, you could still contribute another $72,000 to the solo 401k. So the overall limit is not reduced by contributions made to the day job plan. So that's one thing to clarify in your understanding. In addition, you note that you would look to also make Roth IRA contributions. So it's noteworthy that contributions to a Roth IRA are not aggregated with contributions to the solo 401k. So making those Roth IRA contributions is not going to reduce how much you can contribute to a solo 401k. Now, of course, you want to work with your tax advisor, because if someone makes too much money, they're not able to make Roth IRA contributions. So there are income limits above which one cannot contribute to a Roth IRA. In contrast, with the solo 401k, there are no income limits above which one can make solo 401k contributions. So it's not as if someone makes too much money and they can't contribute to a solo 401k. There are no such limits. So that's a great advantage of the solo 401k as compared to a Roth IRA for those that are in those upper income limits. So, or upper income range, I should say. So hopefully that helps. We do appreciate it. Let me know if you have any follow-up questions. In the meantime, we're going to turn to the content that we wanted to share. But again, we always want to field your questions or topics on these daily webinars. So if you have questions or topics you wish to discuss, please chat it over now so that we can be sure to get to them all. Before we get started, we'd also like you to please like this video. It helps us to get the word out to other solopreneurs, other advisors, others that are just might be interested in these topics. Please like this video, whether you're on LinkedIn, whether you're on YouTube, if you're on X, Instagram, whatever social platform you're watching, you can please like this video. Please subscribe as well, as we do go live every day, and you'll get notifications of when we go live, so you can come and ask questions. You can come and hear the content that we come to share. We also, of course, want to let you know that the content is being provided for educational purposes only, should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So now let's talk about the $72,000 Schwab Roth IRA hack for 2026 via the Mega Backdoor Roth. So this is a $72,000 Schwab Roth IRA strategy. And keep in mind, this is not just limited to Schwab. We're just using Schwab because that's a popular place where individuals will want to open Roth IRA accounts. But you could use this same strategy even at other brokerages, whether it's at Fidelity, Robinhood, E-Trade, Vanguard, down the line. So this is a 2026 guide for high savings solopreneurs. So let's first, at a high level, look at the landscape. So of course, with the Roth IRA, there are contribution limits, just like there's contribution limits to a solo 401k. But the solo 401k contribution limits are much higher, almost 10 times as high. For example, for 2026, your Roth IRA contribution limit is $7,500 or more if you're age 50 plus. But with the solo 401k, the limit is $72,000. Again, almost 10 times as high. So for solopreneurs that don't have any full-time, non-owner, non-spouse W-2 employees working for any business owned by that individual or a spouse, if any, they're going to be able to access a solo 401k plan. And if they use one, like the one offered by my solo 401k Financial, they could end up putting $72,000 in their Roth IRA, including a Roth IRA at Schwab for 2026. So we want to talk about that hack. Now, this is one of the top use cases for my solo 401k Financial clients. And so it's noteworthy that we're talking about at a high level, making contributions to a solo 401k and then transferring those funds out of the solo 401k to a Roth IRA, including a Roth IRA at Schwab. Now, it's noteworthy that there are rules about transferring funds out of a 401k, including a solo 401k. So we want to contrast the rules that generally apply with the rules that apply to making these Mega Backdoor Roth contributions. So generally, funds that are in your 401k cannot be transferred out of the 401k until you meet a triggering event. For example, you're age 59 and a half or older, or you separate from service. Well, separating from service when you're self-employed is not easy because you're not going to typically want to shut down your self-employed business. But there are exceptions to that general requirement or those general rules that the funds are essentially locked inside the 401k. And this strategy will take advantage of one of those exceptions. So one of those exceptions are voluntary after-tax funds. So with this strategy, one is making a voluntary after-tax contribution. So you need to have a plan like the one offered by my solo 401k Financial that number one allows for voluntary after-tax contributions, and then number two allows for the distribution of those voluntary after-tax solo 401k funds out of the plan, including to a Roth IRA. So with this strategy, the individual can make, number one, a voluntary after-tax contribution, but then immediately move the funds out of the plan to a Roth IRA, including to a Roth IRA at Schwab. So this is going to involve, in short, breaking the locks. So that's why those voluntary after-tax contributions are superior to deferrals. So someone might say, well, why don't I make a Roth employee contribution to my solo 401k and then transfer the Roth employee contributions out of the plan to a Roth IRA? And the answer is, well, the rules generally will not allow you to transfer those Roth employee contributions out of the solo 401k to a Roth IRA, even if they're going to another retirement account like a Roth IRA. Whereas if you're making voluntary after-tax contributions, which you need to have a plan that allows you to do that, your basic plans, for example, at Schwab or Fidelity or other discount brokerages, don't even allow for making voluntary after-tax contributions. But if you've got a plan like the one offered by my solo 401k financial, it's going to allow for those voluntary after-tax contributions and also allow for those voluntary after-tax solo 401k contributions to be transferred out of the plan, including to a Roth IRA. So that ability to transfer out of the plan is key. It's fundamental. And then on top of that, those voluntary after-tax solo 401k contribution limits are much higher than your employee limits, right? We talked about at the outset when we looked at the landscape, how the voluntary after-tax solo 401k contribution limits, really the solo 401k contribution limits, are almost 10 times your Roth IRA contribution limits. 72,000 for the solo 401k versus 7,500 for a Roth IRA. But even if you look at your Roth solo 401k contribution limits, those limits are still limited to the employee deferral limit, which is 24,500 for 2026. But the voluntary after-tax contribution limit is the overall limit. So one can contribute 100% of their self-employment compensation, dollar for dollar, up to $72,000 as a voluntary after-tax contribution, assuming they don't make any other contributions to the solo 401k, and assuming they don't make any contributions to a 403b, they can contribute 100% dollar for dollar. So if they've got the self-employment income to justify it, they can contribute all the way up to the overall limit as a voluntary after-tax contribution, then transfer the funds out of the plan to a Roth IRA. So even the voluntary after-tax contribution limit is multiple times, right, the employee limit, the Roth 401k limit. So the key step is to, number one, be eligible, right? So you've got to be self-employed with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. Then you got to find a plan like the one offered by my solo 401k financial that allows you to make those voluntary after-tax solo 401k contributions and then transfer the funds out of the plan to a Roth IRA. Now, it's going to be helpful and logical to work with a provider like my solo 401k financial that, number one, has deep experience. No one has more experience than my solo 401k financial, because we were the first solo 401k provider to offer a plan that supports the Mega Backdoor Roth. It's also going to make sense to work with a provider that's going to be hands-on in helping you through the process. So we are strictly a plan provider. We're not an account provider. So we help customers open up holding accounts at the bank or brokerage of choice. For example, at Schwab, for example, at Fidelity, or if you're working with an advisor, we're neutral. So we're very comparable. We're very compatible with those that are working with advisors, because wherever your advisor custody's at, whether it's at Fidelity or Schwab or Altruist down the line, they can open up the accounts at wherever the advisor custody's at, so they can help manage your investments. But we provide the plan, and we provide the plan that allows you to do this. So the next step is to open up the accounts, fund the accounts. So make those contributions. And we're very hands-on in answering questions, educating customers in terms of all those mechanics, such as how much can I contribute? What's the deadline? What's the mechanics, etc. And then transfer the funds. So part of this, the process is a two-step process. You first make a voluntary after-tax solo 401k contribution to a separate voluntary after-tax account. And then step two, transfer the funds out of the voluntary after-tax account to your Roth IRA. So you first need to get the money into that voluntary after-tax solo 401k account so you can take advantage of those much higher limits. Again, 100% of your self-employment compensation, dollar for dollar, up to $72,000. But then step two, move the funds to a Roth IRA. So now you got the potential for tax-free growth. So once the funds are in that Roth IRA account, it's going to be like any other money in a Roth IRA, where it's got that potential for tax-free growth. And again, this could be a Roth IRA at Schwab. So the brokerage account for the voluntary after-tax solo 401k funds can be at Schwab, and we'll prepare the paperwork to help open up that brokerage account for your solo 401k. And then it could be a Roth IRA at Schwab, whether that's a new Roth IRA at Schwab or a pre-existing Roth IRA at Schwab that you've already had. And then keep the money in the Roth IRA long enough that now you can take a qualified Roth IRA distribution, and now you can take all the money totally tax-free. Now, this time of year, as we sit, and before we get to this time of year, one quick note. When you move the money from the voluntary after-tax solo 401k account to that Roth IRA, that's reportable. The first step, when you make the voluntary after-tax solo 401k contribution, that doesn't need to be reported. It doesn't need to be reported on the personal tax return. It doesn't need to be reported on the business tax return. It doesn't need to be reported on your W-2, for example, if your business is taxed as an S corp. So the voluntary after-tax contribution, that doesn't need to be reported. But the second step, when you move the money out of the after-tax account to the Roth IRA, that does need to be reported. It needs to be reported by the plan on a Form 1099-R. And we handle that 1099-R. So that's another reason to work with my solo 401k financial. So we have the plan, we have the experience, and we provide the support, the 1099-R support. And we prepare that 1099-R for no additional charge. So customers or their advisors just have to let us know, because again, we're not providing the accounts. We don't have access to your accounts, but you or your advisors can just let us know, okay, well, I moved $72,000 from my voluntary after-tax solo 401k to my Roth IRA. We've got a form on our website that can be submitted 24/7. You can find it quickly and easily at mysolo401k.net/forms. That's how we capture the information we need to prepare the 1099-R. And then again, we do it for no additional charge. So now let's turn to the late start reality, right? So here we sit in 2026, and there's a number of individuals that are now filing their taxes for 2025, or they're thinking about 2025 taxes. They're wondering if they can still make 2025 contributions. And the good news is the answer is yes. So it's still possible to set up a new solo 401k in 2026 and make voluntary after-tax contributions for 2025, as long as the plan is set up by your business tax return deadline, including any timely filed extension. Now, if you're a sole prop, you can still set up a plan here in 2026 and make all types of contributions, including employee, employer, and voluntary after-tax. You'd have to make those employee contributions by April 15th, 2026. If you file an extension for your 1040 for your business tax return, you could still make employer and after-tax contributions for 2025 by your extended business tax return deadline. So in other words, by October 15th, 2026. Now, if your business is not taxed as a sole proprietorship and you're setting up a new solo 401k in 2026, let's say your business is taxed as an S corp or a partnership or a C corp, it's too late to make employee contributions for 2025, but there's still time to set up a new plan in 2026 and make employer and or voluntary after-tax. Again, voluntary after-tax is how you're able to put $72,000 in your Schwab Roth IRA for 2026. Now for 2025, the overall limit is $70,000, but it's still a significant amount. Between 2025 and 2026, you could potentially end up with $142,000 in your Roth IRA at Schwab or really anywhere else, as we mentioned. So the 100% voluntary after-tax strategy for 2025, no December 31st setup is required. You could still set up a new plan in 2026 as long as you set it up in time to make those voluntary after-tax contributions by your 2025 business tax return deadline, including any timely filed extension. Again, funds are contributed to the voluntary after-tax account and then transferred either to a Roth solo 401k or out of the plan to a Roth IRA, such as the Roth IRA at Schwab. There is a contribution deadline. It's the business tax return deadline, but there's no deadline to transfer the funds out of the plan to a Roth IRA or a Roth solo 401k. So the critical deadlines, again, are your business tax return deadline. It's not necessarily your 1040 deadline. If your business is taxed as an S corp or a partnership, you're looking at March 16th or September 15th of 2026. If your business is taxed as a C corp or a sole prop, April 15th or October 15th, 2026 for those voluntary after-tax contributions for 2025. So let's go over the math with a simple example. Let's assume the individual is under age 50 in 2025. They have at least $70,000 of self-employment compensation for 2025. They could skip employee, skip employer. They might have to skip employee. For example, if their business is taxed as an S corp, but they didn't set up a plan until 2026, but that's fine. They could skip it. They can skip employer. They can make 100% voluntary after tax, 100% of their self-employment compensation, dollar for dollar, up to the 2025 overall limit, which again is $70,000, and make those contributions, then move the money from the after-tax account over to a Roth account. Could be a Roth solo 401k or a Roth IRA, where you've got that potential for tax-free growth. Again, no deadline to convert from the voluntary after-tax to the Roth account. That's going to be reportable for the year of the conversion. So if those 2025 contributions are being made in 2026 and then converted in 2026, it'll be reported on the 2026 1099-R. We then provide that 1099-R by 2027, the beginning of 2027, by February 2027. You would then share that with your tax advisor, so it could be reported accordingly on your 2026 1040. Now, this slide is helpful as it gives us a good visual of what the account setup might look like. Here we've got one person and they've got two holding accounts, right? They've got one account for pre-tax dollars. This could be for pre-tax contributions or maybe pre-tax money that's rolled over, say from a former employer plan or a non-Roth IRA. Then they've got their separate voluntary after-tax account. Again, could be at Schwab, could be at Fidelity, could be at a bank. As part of the onboarding process, we help our customers open up the accounts at the bank or brokerage of choice. So that's the account into which they make those voluntary after-tax contributions. And then step two, move the money out of the after-tax account to a Roth IRA, including, again, a Roth IRA at Schwab. So thank you so much for listening as we went through those slides. Again, if there are additional questions or topics you wish to discuss, please chat that over now as we do have a few more minutes. In the meantime, we want to invite you to our community. We've got the largest community of solopreneurs, advisors, just interested parties with over 30,000 members. We've got vibrant forums. We have a library of videos and webinars. So there's a ton of ways to learn, a ton of ways to share the knowledge. It's totally free to join. All are welcome. You can join quickly and easily at mysolo401k.net/my-community. And again, if you could please like this video, it would be greatly appreciated, whatever platform you're on, whether you're on LinkedIn or YouTube or X, as that helps us to get the word out to other solopreneurs who might be looking for this type of information. All right, that's it for today's Solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this Solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement.